Welcome back. Well, winters are upon us, and one company that traditionally had a larger exposure actually to the winters was Monte Carlo. They have de-risked their portfolio a little bit, but to understand how this business is shaping up, we're joined by Mr. Sandeep Jain, the executive director of the company. Hi, Mr. Jain. Thanks so much for joining in. Well, one factor that the street was disappointed on in the second quarter was your revenue growth was only 5%. Now, you've been guiding for the growth of closer to 25% for the year. So first up, tell us, why did you grow by only 5% in the second quarter? And do you stick to that guidance of 25% for the year? Go ahead, Sandeep.
Yeah, thank you, Nigel. So whenever we give our guidance, we give our annual guidance because there are quarter-to-quarter variations depending upon the festivities, depending upon the festive season, depending upon the start of winter season. So overall, the guidance remains same, but there can be quarter-to-quarter variations.
So you are confident of 25% growth. I mean, the first half you grew at 29%. The second half usually is a much stronger quarter for much stronger period for you. The third quarter, of course, accounts for majority of your revenues. So is there a chance that you can actually outbeat this 25%? It's getting colder.
As of now, we are sticking to our previous guidance of 20 to 25%. But as the season goes ahead, we see November and December and January. So if the demand has been very good, we can revise our guidance also.
What have the early trends been in terms of demand? And also, the second quarter, I presume you would have exhausted a lot of your high-cost inventory. Since then, we've seen some reduction in input prices as well. So how has that panned out for you?
See, season has begun well. And as far as there are three factors for that. One was as there is no restriction this year after the COVID, so everybody was going for revenge shopping. And secondly, weddings have started in a big way in northern India as well. And there are even parties are happening and the winter is on time. So all these three factors are favorable for us. And we are very hopeful of achieving our guidance. And I think we'll be maintaining our margins as well.
Maintaining margins of what, around 18 to 20%?
We have given a band of around 21% EBITDA plus minus 100%. So we'll be maintaining that.
So around 20, 21%. Got that. Sir, I wanted to ask you about the company-owned EBOs. That will give us a better sense about demand because you're realizing, the sales immediately as it happens. Give us a sense if you have to compare 2022 winters with 2019 winters, particularly in this segment. That's the company-owned EBOs. How much better is it?
See, 2019, pre-COVID, we are far ahead for that because last year we grew around 45%. So we are far ahead as far as pre-COVID level sales are concerned. Even we are growing from the last year's sales also. But the exact data is not available with us because we get the data only, once we have October, November, December, all the 3 months are realized. But we are hopeful that we'll be growing around 20-25% as compared to last fiscal.
Sandeep, I'm just trying to understand particularly about this segment. That's the company-owned EBOs. You're saying that the sales even this year will be better than last year and better than 2019 as well, right?
Yes, of course.
Okay.
All right, we take that point. What about ad expenses? Because in the second quarter, while your gross margins improved by 400 basis points, I presume that was on account of, easing in raw material prices, etc. as well, and you realizing a lot more for your sales. You spent a lot more on advertising. Was this a one-off ahead of the third quarter, or is this likely to be the run rate going forward? Because in the second quarter itself, you spent about 5% of your sales on advertising.
See, I'll explain. See, what happens before COVID, we were spending 3 to 4% of our advertising cost.
Right.
And once in COVID, we started only 1 to 2%. But now we have given the guidance of 2 to 3% of advertising cost. So in second quarter, it has gone, very high. But in third quarter and fourth quarter, it will average out. So overall guidance will remain same at 2 to 3% as far as full fiscal is concerned.
Okay. All right. Sandeep, the other factor is, input costs have cooled off. Whether I see it on yarn, cotton, and that will be beneficial for you. But you will be sitting on some inventory. So from which quarter onwards will we start realizing this benefit? Some part of quarter 4 or quarter 1, or what is it?
See, normally when the input cost goes down, it takes 6 months to get the benefit of that. Okay. So if it has now gone down, so you'll be realizing it in first quarter of next fiscal.
Okay, first quarter of next fiscal. So we'll talk about margins then about the next year. But you have been veering away from woolens as well. I remember summer, being just about 35% of your sales. You wanting to take it to around 45% of your sales as well. But also wanted to understand about home textiles, because you had a couple of plans in terms of increasing blankets capacity, etc. Accounts for about 20-25% of your sales currently. How much is it likely to be going forward?
I think we are very bullish on home textile segment, as it has been growing around 30-35% per annum. And this year, we hope to close around 160 crores of home textile sales. So as we announced earlier also, we are coming up with the blanket manufacturing plant at J&K in their central government's policy.
Okay.
So that plant, we think that would be operational in the third quarter of next financial year, and that will again add to our revenues.
Okay.
So we are confident of growing 30-35% this financial year in home textile, and the growth will be more when the plant will be operational.
Right, and in FY24, you'll have the benefit of this new plant J&K, and you are putting in what, 80 crores, right, in this unit?
Yeah, around 80 to 100 crores.
At optimal levels, what kind of sales can you realize?
See, some of the sales, some of the production will be used in-house, as already we are outsourcing it, and rest will be selling it in the market. So additional component of sales, which will add to our revenue, should be around 70 to 75 crores.
70 to 75 crores. All right, and this entire unit is for home textiles itself?
Yeah, it's for home textiles.
All right, it's been good speaking to you, Sandeep. Thanks so much for stopping by. You're looking reasonably optimistic about business from here on. 20 to 25% growth in terms of revenues. Home textile, that'll grow at a faster clip, and margins in the vicinity of around 20 to around 21%. On the back of that positive commentary, seeing a bit of an uptake on the stock. Remember, post quarter two, the street was a little bit disappointed that the revenue growth was only around 5%. But as the management clarified, we need to look at it on an annual basis, and they're confident on meeting their guidance. For the time being, we'll slip into a short break. On the other side, we'll get you excerpts